Hi everyone, I am Ushma and welcome back to my channel. In today's video, we will be diving into the latest updates on capital gain taxes and TDS related to equity shares and mutual funds. These changes effective from July 23, 2024 are crucial for investors and you don't want to miss this. So let's jump in. Let's start with capital gain tax first. There have been significant updates and we will cover both listed and unlisted equity shares along with equity and debt mutual funds. So whether you are a long-term investor or an active trader, these changes will impact you. Let's first discuss listed equity shares. If you hold listed equity shares for more than 12 months, it qualifies as long-term. Before 23rd July 24, LTCG was taxed at 10% on gains above rupees 1 lakh. But after Union Budget 24, the tax rate has been increased to 12.5% and the exemption limit is now rupees 1.25 lakh. So only gain above rupees 1.25 lakhs will be taxed at 12.5%. In other words, exemption limit has been increased to rupees 1.25 lakh from rupees 1 lakh, but tax rate has also been increased to 12.5% from 10%. Now let's discuss short-term capital gain on sale of listed equity shares. If equity sold within 12 months, the gains are short-term. Earlier, STCG was taxed at 15%. But now the rate has been increased to 20%, which could affect frequent traders. And now what about unlisted equity shares? For unlisted shares, the holding period for LTCG remains 24 months. Earlier, LTCG was taxed at 20% with the benefit of indexation, but now LTCG taxed at reduced rate of 12.5%, but the indexation benefit has been removed. This could result in higher taxable gains for shares held over long periods due to inflation adjustments no longer being applicable. However, short-term gains from unlisted shares held for less than 24 months will continue to be taxed at the individual's income tax slab rate. Now let's talk about mutual funds. Let's first discuss equity mutual funds. For equity mutual funds, the holding period is 12 months for long-term capital gain. Earlier, LTCG on equity oriented mutual funds was taxed at 10% on gains above rupees 1 lakh, but now the rate has been increased to 12.5% and the exemption limit has been raised to 1.25 lakh. And for funds held for less than 12 months, earlier STCG was taxed at 15% and now the tax rate has jumped to 20%. It means taxability of equity mutual fund is same as listed equity shares. Let's talk about debt mutual funds now. A significant amendment was made in Finance Act 2023 that directly impacts investors in debt mutual funds. Please note, I am talking about Finance Act 2023, not Finance Act 2024. So previously, that is before 1st April 2023, if you held a debt mutual fund for more than 3 years, the LTCG was taxed at 20% with indexation. However, under the Finance Act 2023, this indexation benefit has been removed. So now, regardless of how long you hold the debt mutual fund, the gains will be taxed at your slab rate, just like short-term capital gains. Simply put, whether you hold the investment for 1 year or 10 years, the tax you pay will depend on your total income, and there is no more inflation adjustments. This rule continued to apply even after the Union Budget 24. For clarity, when we talk about debt mutual funds, we mean funds where less than 35% of the proceeds are invested in equity shares. So, in layman's term, if you have invested in debt mutual funds, then expect to pay tax on the gains based on your income tax slab. However, that's not all. In upcoming videos, I will cover other popular investment instruments like bonds, ETFs, REITs, InvITs and gold funds. So stay tuned for that. One more important point which I want to discuss is TDS rates. For NRIs, TDS rules on capital gain tax have been aligned with the new tax rates. So, for LTCG, earlier 10% TDS on LTCG from listed shares and mutual funds were applicable, but now TDS has been increased to 12.5%, which is in line with the new LTCG tax rate. Similarly, for STCG, 15% TDS rate was applicable earlier, but now it has been raised to 20%. But please note that TDS is generally not applicable for resident investors, but for NRIs it is applicable. So these changes will be applicable for NRIs. I am talking about TDS. NRIs must account for these changes to avoid surprises at the time of filing taxes. And I can see lot of NRIs are interested in investing in India, especially in mutual funds. So I believe taxation is an important part of every decision related to investment. I hope this video will give you an idea that how new changes will impact your final outcome. And that's a wrap. Thanks for watching the video. If you have any questions or would like more clarity on any of these points, please feel free to reach out to me. See you in my next video. Thanks.